What's going on, guys? Welcome to episode 5 of Property is a Game of Finance. Today we are joined by Aboho from KHI Partners, and Jay from our marketing team is also joining us today. Today we're going to talk a little bit about Aboho's role as an accountant and among other things. But how you going, man?
Not too bad. How's things going on your end?
Yeah, pretty busy. Thanks
Yeah.
for taking out the time.
No, absolutely. Happy to help and happy to be a part of this. It's good for both you and me to get out there, exchange some ideas.
That's it. So I think a good place to start would be how long you've been an accountant, what got you into it in the first place?
Yeah, good question. Look, my background's been in accounting has been like 8 years now. I started off my career in equity research, so in asset management, investment banking, so on and so forth. Kind of did that for a little bit, and then moved over to commercial banking.
Did you have to go to uni to go do those jobs?
Yeah. So I got my bachelor's in finance during the world financial crisis. So that was a fun time looking for a job. But once I'd done that, I kind of went straight into equity research, which is kind of a lot of Excel modeling and looking at stocks and shares and trying to understand the fundamentals of why prices in stocks go up or down. And then kind of got disillusioned a little bit because what I specialized in was emerging markets. And emerging markets traditionally haven't really been driven by fundamental analysis for stock prices as such. It's more because it's small cap stocks, they tend to be more swing trades and tend to go up and down based on I suppose, rumor and innuendo more than anything else. So once I moved on from that, I moved over to commercial banking. And I think I enjoyed that a lot more because I was dealing with like real people and real assets and real businesses that were growing. So that kind of sparked a curiosity in me to kind of, I suppose, work with businesses and help them grow. I got poached by one of my clients actually that needed help in raising debt and equity. So I moved over onto them, did a bunch of things for them, both in the manufacturing space and real estate space. And then I moved to Australia. And I've been an accountant.
Where are you from?
So I was born in Libya. My parents are Bangladeshi, as am I. But I'm a global citizen. Let's just say that, because I've been in and out of countries for most of my life. But Australia's home for now. Coming back to it, so when I moved to Australia, I suppose I started off in accounting, which is, I suppose, an easier place to fall because there is quite a bit of space where accounting and finance kind of have things in common. So started off did that for a bit, worked in a couple of accounting practices, and now I'm a part of an organization called KHI Partners. I'm an accountant there. I lead one of the practices. But yeah, that's been the spiel and the story so far.
So why accounting?
Look, I'll be honest, I am a numbers guy.
Yeah.
I think accounting, sorry, I just got told to bring the mic closer. I've been, so I'm a numbers guy, but more than that, I'd like to tie in a story to the numbers. Accounting in when you first get into it, it's just numbers, debits and credits, so on and so forth. What people often don't see behind it is there's a story behind it. And without getting too geeky or nerdy about it, is that's the interesting part of it, is looking at the numbers and understanding what the client or any potential business is lacking, finding out the story behind it, and perhaps putting your 2 cents in and helping them grow as such. So that's probably the more entertaining part of it.
Yeah.
And the part that I'm probably a little bit more passionate about.
Yeah. So do you plan on being an accountant forever?
Yeah.
You got other plans?
Yeah. No, that's it.
All good.
Associated businesses, of course, but I'm an accountant. Yeah.
Yeah, nice. So I guess it'd be good to touch on the importance of what an accountant's role is when you're investing in property.
Yep.
I tend to send people to you a lot because anytime they ask me something, is it tax deductible?
Yeah.
I can't tell you that.
Yeah.
I have to send them over to you. So especially when they haven't got a portfolio, most people just wouldn't have an accountant. But
Correct, yeah.
then it's recommended to have an accountant once you start to build a property portfolio. So what do you think are the main things around that?
Look, there's 2 ways of looking at it, right? There is the case to be made where you're a tax accountant, which I am, The case is, okay, you come see me come tax time, and I try to get you as within the rules, try to get you as good of a refund as I can. That's probably something that a lot of accountants can do. Potentially a smaller part of what I do. That's probably I try to downplay that fact because what I like to tell my clients is I can get you back as much money as you want, but that also means that you've spent $1 to get 30 cents back, which is not the smartest strategy. I think the role of an accountant is evolving, and I think it is more of an advisor role as such. With the clients, big or small, whether it's a retail investor or whether it's a large company as such, I think it's incumbent upon the accountant to take a general view, not only on the tax side of things, but also to understand, hey, if I claim these deductions or if I take these expenses, does that hurt my chances of borrowing in the future? Does that hurt my chances of, I suppose, expanding? So the role of an accountant, like I was saying before, is evolving over time. I think traditionally what we do is we go to our accountant once a year and ask him for the biggest refund possible, and potentially get annoyed when we don't get it. But over time, what's happening, and I suppose this is probably a larger part of what I do, is yes, of course, I'm a tax accountant. Of course, we are going to look to strategies and ways to optimize our tax strategy. But on the other hand, I'm also a record keeper. I'm also and I think it's incumbent upon all accountants to be, I suppose, not so much giving advice, but at the same time being generalist in a nature where you look at the financial accounts of a client where you can tell straight away, okay, here are the gaps in how you're running your business from obviously not an operational side, but a financial side. And then you can look at perhaps certain expenses they're taking that probably hurt their borrowing capacity in the future. Then on the other hand, you look at their goals and objectives and you try to kind of look at their tax strategy and align those in certain ways, shapes and forms. So there's a lot that accountants nowadays should do, rather than you meeting a client once a year and giving him the biggest refund you possibly can. Perhaps it's more than once a year that you meet him. I know for my clients it's a minimum of twice a year, and they have my number and they can call me at any point in time to run through whatever ideas they may have, and I can kind of put it in my put my glasses on, try and look at that investment or try and look at that I suppose move in their business and understand, okay, is this the right move for them? At the end of the day, it is the client's decision. Of course it is. But it is incumbent upon the accountant to point certain things out.
Yeah, I know what you mean. Because the way we actually met was through Jeremy, and he was my accountant. He's been my accountant since, Steve Polisi put me onto Jeremy, and this was would have been in 2015 or something.
Wow.
Really early.
Okay.
And I had started and failed 3 businesses before I became a broker.
Nice.
So me and Jeremy, yeah, it was just, it's funny. But yeah, I leaned on him a lot throughout that, and he knows my financial situation better than anyone. So that was really good. Now, I wanted to touch on the pros and cons of buying property in your trust name.
Yeah, good question. Look, now the primary use of and trusts have been used for hundreds of years, right? The primary use of a trust is asset protection. I don't recommend using, I suppose, what is now known as negative gearing as a strategy to buy properties under a trust. Primarily because you cannot distribute losses in a trust that derive from that negative gearing back to whatever beneficiary there is. Losses can be absorbed against profits, but losses cannot be distributed. Having said that, it does provide pretty good asset protection for clients.
I keep hearing people say that, but so if you get personally sued, they can't touch your properties when it's owned in trust.
I mean, that's a very, I suppose, simplified way of saying it.
Yeah.
It also depends on how the trust is structured, right?
Yeah.
Again, no advice. You need to go to your.
I know where you're going.
You need to go to your accountant to get that. And quite often I've come across trusts that are not structured the correct way, and probably don't provide any asset protection.
Depends on your profession. How often would someone just get personally sued and have all their
Correct.
properties at risk,
Look, there's the sue. Then there's other parts of it, right? Like if there are changes in family, so on and so forth. So certain people try to leave assets as intergenerational wealth, so that there's no one owner, so to speak. There's different ways to kind of hold it in. I don't know. I don't want to use the word perpetuity, but to use it to hold on to things for a long period of time.
Yeah. I think from a financing standpoint, with trying to borrow under a trust, not every lender does it.
Yep.
And then you can't use negative gearing in the servicing calculator for it, so it affects servicing as well.
Yeah, that's right.
So, but yeah, each to their own.
Yeah.
Debt recycling.
Yeah, good. So just so we're across the same concept, what I understand debt recycling is you're paying down your non-deductible I suppose debt, and then using that to kind of finance your deductible debt expansions, so to speak. Are we across the same
same
concept? Okay, cool.
Because I had a client, he wanted like 5 splits on his owner-occupied loan, so that he could pay off the full amount and then take it back out of the redraw and invest it in stocks. Does it have to be in a separate split, or can it just be all in one?
I wouldn't advise that at all.
Well, if he's going to do it anyway, it's tax deductible interest.
It is, but without giving financial advice, guys. I mean, if you're going to take
people watching this at home, every time he says without giving financial advice, got to have a drink.
Or tax advice. It's coming back to why I think it's a dangerous strategy. You're basically borrowing from a less risky asset to invest in a more risky asset. That in itself comes with a host of problems. But on top of that, you're levering on top of that. It just multiplies the risk in 10 different ways.
I think when people get to that point of like debt recycling, I think it's just like something cool and exciting that they want to do.
Yeah. Look, and I do get the concept, especially in a low interest rate environment. I mean, what besides, if you've got a few bucks lying around, what would you rather do? Keep it in a savings account earning, I don't know, 0.5%, whatever the interest rate is, or pay down your the debt on your principal place of residence. And then you can use that later on to draw on and invest in more properties and do what you need to do. Debt recycling, big fan of. Again, it has its place, right? So there's a concept called opportunity cost. So anywhere you invest in has opportunity cost. It's probably a good idea to understand before you get into that debt recycling and paying down your principal place of residence. Is that the best use of your money? If it is, absolutely. But you should probably still keep it in the back of your head that, debt recycling, whilst great as a concept and as a tax strategy sometimes, is it the best use for my money? That's basically what it is about. Yeah. So
I think another thing I wanted to touch on was exit strategies, because as clients are approaching retirement, I think the person that first lean to would be the accountant. Someone that's managed their finances their entire life. If they're business owners, I think that'd be the first person they ask.
Right. So us as KHI Group, we're not just accountants. We have partners in financial planning. We've got a legal practice. Got mortgage broking as well.
Don't worry about that.
Don't worry about that.
Don't worry about them.
Don't worry about them. So it's a number of associated businesses. So you're right. That's the first person that they lean to. And the reason they lean to it is we try quite actively to be generalists. And that means we have a little bit of knowledge about everything. Now, how does that tie into retirement? Ideally speaking, if you're planning retirement and you're going into retirement, you probably should take the advice of a financial planner. Just to understand what your expenses are going to be once you retire. Do you have enough savings? What do we need to do? There's also a succession planning, so on and so forth, that you can also visit with the legal partner and such. So those are a couple of things over there. Now, from a tax strategy as such, there's a couple of strategies here and there, downsizer contributions, so on and so forth, that you can utilize. All of it depends on, how are you going to fund that retirement? Is it through assets that you own personally, or is it through drawing a pension? The reason why I'm not giving a straightforward answer is because there isn't one, right? Like every
Yeah.
person, every retiree, their personal circumstances are different. So yes, absolutely, reach out to your accountant, and hopefully, if he's a good accountant, he will point you in the right direction, take the right advice, and give you as many tools as possible to make the right decision.
Yeah, nice. One question I wanted to pick your brain on. So, what do you think the long-term effects of COVID and government spending is going to have on the property market, the finance market in general?
Yeah, good question. Okay, this is going to
Because
be
that's all tax money, right?
Yeah.
It's all the
Yeah,
money we
somebody's
spend
gotta
in
pay it,
tax.
yeah.
Yeah, we're all going to pay for it.
Yeah. Over the next 120 years, that's fine. Look, without getting political, without
There's an election looming.
yeah, there's an election going on.
Now, so, like, what was Australia's debt pre-COVID and what is it now?
Okay, so I'm not going to tell you percentage levels because I don't want to get it horribly wrong.
Yeah.
It's definitely higher post-COVID, right?
Oh, yeah.
And the reason why is you've had a number of chances for the government to restart the economy, so to speak. This, I think, in my head, and I might be wrong, but in my head, it's part of a longer cycle, right? Quite often, there's two-pronged approach that the government uses to kickstart an economy. One is obviously the monetary policy. We've seen interest rates close to zero for a very, very long time. We've only recently seen interest rates rise. So that's from the one point, the government trying to, I suppose, inject liquidity into the system. There's also other parts to it where they do quantitative easing, so on and so forth. But let's leave that as, for all intents and purposes, what is known as monetary policy. There's another called fiscal stimulus, which is government spending. I think, given the interest rate scenario for the last couple of years, there was no other option except government spending to kickstart the economy, especially when COVID kicked in. Because I mean, that's the only way you can I suppose spur on economic growth. Do I think this will be a phenomenon that is somewhat sustained? Yes, I do. Potentially, depending on who you ask, are we headed to stagflation territory where there's rising, there's a recession and inflation at the same time, so to speak? Maybe, probably not in my head. In Australia, in America, possibly.
Why do we do so much better than other countries?
Look, very short answer. We have a lot of resources
And not a lot of people.
Not a lot of people, and we have a fairly good workforce.
Yeah.
Now, when I say resources, I don't just mean gold, copper, tin. There's also land.
Yeah.
Land's a massive resource, and why is it a resource? If you look at the potential immigration coming in over the next couple of years with 200,000 people, they need places to stay, right? And land is a resource that they can use. So that's another quiver the government can potentially have in their arsenal, which is to increase immigration to kickstart the economy as well.
A lot of that land's desert, but you don't want to be living there, man.
Yeah. I live in the desert. I live in Western Sydney, man.
I wish I had my phone case here. I got a Western Sydney phone case.
Yeah.
So do you think it's a good time to buy then?
It's always a good time to buy, depending on where you buy.
On your circumstances, yeah.
And depending on your circumstances, depending on where you buy, there's always a deal to be had. As I was telling you earlier, the old adage is for real estate, when's the best time to buy? Now, if not 10 years ago. When's the best time to sell? Never. So it's always a good time to buy, given that it's the right, I suppose, financing structure, given that it is the right thing from a investment point of view, and we're not just jumping into the market for the fear of missing out. That's all it is.
Yeah. I know we've had this conversation before about buyer's agents.
Yeah.
And we had a long 30-minute conversation. I was just pacing up and down the street going...
No. I think you misunderstood what I was trying to say. But
no, I kind of get you.
I think buyer's agents are important.
Yeah.
They are important. And it is a tool like everything else. The point that I was trying to make is I think in recent times there's this ongoing theory of passive investment. And in my head, there's nothing called passive investing. You cannot be passive with your investments. These are you work very, very hard for that kind of money. And if you take a hands-off approach towards your investing, it's going to tell in your returns.
Mm.
Buyers agents are very, very key in that they focus your efforts and they give you options to have.
Yeah.
But at the end of the day, you still need to do the checks and balances.
Yeah.
Still, at the end of the day, you're making that investment. They can only provide you suggestions. It's also important for people to understand what they're investing in. What is it that they're really investing in?
Yeah.
Like, is it the land? Is it the building? What am I buying? Am I buying an apartment? What am I really buying? Am I chasing yield? Am I chasing capital gains? All of that probably you need to sit down and do a little bit of research yourself as the retail investor.
Yeah. How I see it is it's like going to do your taxes on your own without using an accountant.
Correct.
Or going
yes.
direct
Absolutely
to a lender
right.
without using a mortgage broker.
Absolutely right.
I'd say that takes out a lot of the legwork because these people they're passionate about property. They've been investing for
and
hundreds
they
of
got
clients.
boots on the ground. They got boots on the ground.
Yeah, so it takes out a lot of that research. And
absolutely,
man, the average person who's going to know how to interpret the data and
absolutely
make the right decisions without help.
Having said that, I put it on the client to learn that, though. They need to learn. Of course, nobody has the tools on day one. Nobody does, but they need to learn because there is not. Again, I'll say it. There's nothing called passive investing.
Yeah.
I think there is a ongoing philosophy which is move away from doing as much work as you can. Embrace the work. Because this is your future. You work very hard for that money. Why just leave it to another person? Even as an accountant, I do several checks and balances before I finalize anything with the client, because at the end of the day, client needs to be comfortable and needs to know what's going on with his finances and accounts.
Yeah. Nice. Hey, you've been quiet. What's going on?
Yeah.
I loop you in. You haven't said a word.
Yeah, these conversations are way above my head.
What are you talking about? I'm your accountant.
Yeah, exactly. I get him to do everything.
My idea was
I take an hour off every quarter to try and speak to him. And he's like, yeah, that's fine. Don't worry about it. I trust you.
See, guys, if you have a good accountant like Aboho from KHI Partners, he'll do everything for you. So
no, because in the last podcast we did, after it, we were sitting around talking, and we could have done another episode just from our conversation, because the questions that he was asking the previous guest, it was like questions from a point of view of like, I know nothing, like and most of the audience who are not in the industry, that's the type of stuff they want to know.
Absolutely.
So that's why I thought it'd be good to.
I actually have a question.
There we go.
That's cool. So I'm currently in talks with Jacko, Mr. Mortgage Broker over here, for my very first property. But what's actually scaring me, and I'm pretty sure it's what's scaring everyone in the current market, is elections, recessions, depression. All this negative stuff that's happening in the markets at the moment. And obviously, I want to listen to the advice. Don't time in the market. It's better than timing the market. But how do you get over that fear of like, I could buy tomorrow and then the market could drop 100 grand. Like, what do I do?
You want me to take it?
And I don't expect financial advice. I just want to know your take on things.
It's definitely not financial advice or tax advice. A simple way of getting rid of the anxiety is to understand that the real estate investment is a long-term gain. If you take that view that, hey, I'm going to buy this property and I'm going to hold on to it potentially forever and never sell it, all I want is for it to hold its value, of course. That's the research part of it. The other part of it is I want my yield. I don't want to spend too much on repairs and maintenance, so on and so forth. All of that is part of it. But the idea is, historically speaking, property cycles go in 7-year cycles. But you shouldn't buy a property thinking that you're going to double your money in 7 years. It shouldn't be the philosophy. The philosophy should be you invest in something that is solid, that is good, that has potential for growth. What the markets do is probably should be farthest from your mind. The anxiety, again, gets rid of by thinking that it's a long-term investment.
And look, in saying that, what's to say that if I buy tomorrow, it's not going to become the 2008 crash, and then your value just go half in terms
Good point. And the way to kind of analyze it is going back. And I look at the economy like a mechanic, right? What is leading to all of this? What led to the 2008 collapse, right? Is there too much debt in this market, so to speak? Now, in my head, if we have, 32 odd million is our population?
Yeah, around there.
Yeah, let's say it is, right? And you've got the ability to increase the population by 200,000 immediately. I don't see that as and that population obviously has to live somewhere. I don't see, barring any major catastrophe in the economy or major kind of change in policy, I don't see how houses aren't going to get rented, if that makes any sense. If you're buying a property, what your first target is, do I have a tenant in it? Will the tenant pay my bills? Right, that's the first target. In if I look at I suppose the population and its potential growth, I don't think the supply and the demand outstrip each other significantly for a major crash to happen. Yes, there will be a price correction. There always is. But again, if we are not worried about if the price correction happens over the next 2 years or 3 years or 4 years, if the price correction happens 4 years and we've got an investment horizon of 20 years, does it really matter? Does it really matter? You've said the markets crashed in 2008, but it recovered quite strongly right after, didn't you? So if you have that long-term investment time frame, these little blips and vagaries in the market don't matter as much. What might matter is a structural change in the economy. That's more a long-term horizon, like 50 to 100 years or 50 to 80 years even. So if you factor that in, probably that might help you get rid of your anxiety a little bit. It's for the long term. Don't worry about it in the short term.
Like if you bought a $500,000 house, shit hit the fan, it's worth $100,000 less. You're not actually going to lose that money until if you sold it, yeah, you'd lose. But if you just weathered the storm, you had the cash buffers and you could hold it, it was tenanted, you'd come out on the other side. Like it's not like investing in stocks or crypto. You know, you look at it every day and like it's like, oh no, it's up down, it's up down. It's not like that. It's honestly once it's tenanted. Yeah, I put money in just before it like only a couple of weeks ago, just before it went.
Hey, what did I tell you? What did I tell you a year ago about crypto? But that's okay. Look,
what'd you tell him?
I told him get out as soon as you can.
Really?
For the short term, again, it is because it is
so volatile.
It's a nascent market, so it is going to be volatile, right? Like it's a new product. People are still figuring it out. People are still even trying to understand what the fundamentals are. So it's still going to be somewhat gambling at this stage, and then over time, it's going to kind of even out as it becomes more accepted as currency or technology or whatever it is.
All right, no worries. Well, thanks for watching. Thanks for coming, man.
Thank you.
Thanks for joining us, Jay. Thanks for jumping in right at the end there. That was good.
That's good.
So all of Aboho's details are going to be in the show notes. If you like this episode, please like everything, share it with everyone, leave reviews. Thank you very much.